Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So, you look at your investment portfolio right now, you might be feeling, well, pretty good.
Mm,
But then you go to the grocery store or the gas station and you feel terrible. It really seems like we're in this moment where economic reality is just completely
that's
fractured.
solely split.
So our mission today is to cut through that noise. We're going to try and pull out the three crucial high-level shifts that are happening right now, all based on some recent data and analysis.
Yeah, we're looking at three major themes. First, we have to unpack this widening gap between Wall Street, the stock market, and Main Street, the tangible, real economy.
Right.
Second, we're going to dive into a very focused political move by the Trump administration. They're targeting high food prices, and they're doing it by blaming specific foreign companies.
Okay, that's interesting.
And finally, we'll look across the Atlantic. Europe is making this huge structural pivot toward defense and energy independence. And that's creating some massive decades-long investment opportunities.
That sets the stage perfectly. Let's just jump right into that first puzzle, because the analysis we've seen paints a really confusing picture of the U.S. economy. Stocks are up, but the overall health indicators are flagging. How do we make sense of that?
Well, we're seeing what you could call one-wheel growth.
One-wheel growth.
The big financial indices like the S&P 500, they're being driven almost entirely by enthusiasm around big tech, AI services. That one wheel is spinning really fast. But if you look at the health of the broader economy, where most people actually work and live, it is struggling badly. And we measure that with the leading economic index, or LEI. So the stock market wheel is speeding ahead, but the real economy wheel is just stuck in the mud.
Okay, so for those of us who aren't tracking every single index, day in and day out, walk us through that difference. Why should we care more about this LEI thing than just the daily S&P 500 number?
It all boils down to what they're made of, their composition. The stock market reflects investor feeling, sentiment, and liquidity.
Right, the mood.
Exactly. The LEI, though, is heavily weighted toward the old-school, real economy stuff. Manufacturing orders, building permits, what people expect for jobs, and, crucially, the spread between interest rates. When the LEI drops consistently, it's not just a number. It's telling you that the factories, the construction sites, the places that employ millions, they are actively shrinking.
And according to the data, manufacturing is the main thing, the primary culprit, dragging the whole LEI down. Why? Why manufacturing specifically?
It's the relentless pressure from high interest rates. We're seeing a huge decline in the ISM index of new orders for manufacturing. You can think of that ISM index as sort of the economic temperature gauge for factory managers.
And what's the deal with the number 50 for that gauge? Why is that so important?
50 is the magic number. It's the dividing line. Anything above 50 signals expansion.
Things are good.
Things are good. Factories are getting more orders, backlogs are growing, they're getting ready to hire people. But a reading below 50 signals contraction. And the data shows consumer spending is slowing down, borrowing costs are high, and so factory backlogs are just, well, they're shrinking fast. This is the single biggest negative signal in the entire LEI, and it confirms the real economy is slowing way down, even if tech stocks are hitting new records.
And that legacy effect of high rates you mentioned, it seems like it's doing more than just shrinking orders. It's causing real structural damage through the banking system, isn't it?
Precisely. This is probably the deepest insight from the data. For the last 2 years, we've had a deep and prolonged inverted yield curve. And all that means is that the interest rate banks pay to borrow money short-term is actually higher than the rate they earn when they lend that same money out long-term.
So wait, if I'm a bank, my basic business model, my profitability just vanished.
It's gone.
Yeah.
Exactly. Your lending margin gets squeezed or, in this case, completely inverted. The result is a sustained credit crunch.
Yeah.
Banks just naturally become hesitant to lend, especially to the small and mid-sized businesses that are the real engine of Main Street.
And that starves the real economy of capital.
It does. It forces healthy companies to delay expansion, or worse. That shockwave is still spreading through the system, exerting just this tremendous negative pressure, even as we hear hints that the Fed might cut rates someday.
And you can see that pain so clearly in the housing market. I mean, even if you own AI stocks and feel richer on paper, the dream of buying a house is still out of reach for most people. The data on building permits proves that.
It does. Building permits are dropping because high mortgage rates are just a brick wall for most buyers. So construction companies, they're delaying projects because they know the demand isn't there at these prices. And all of this feeds right back into the public mood. We see the consumer expectations index staying cold. People are worried about inflation. That stagflation fear is very real, and they're worried about their jobs. And that completely wipes out any good feelings they might get from, checking their 401k.
So for you listening, what does this huge gap, this divergence tell you about your own financial situation right now?
It means your success right now depends almost entirely on where your money is. This Wall Street boom is happening in a silo. If you own AI, semiconductors, big tech, you're doing great.
You're feeling that lift.
You're feeling it. But if your portfolio, or maybe your job, relies on cyclicals, things like steel, machinery, general consumer goods, then you are feeling that LEI decline acutely. The real economy is undeniably hurting.
Okay, this is where it gets really interesting for me because history tells us this gap. It always closes, one way or another. So what's the one crucial signal investors should be watching for? How do we know if the real economy is finally catching up or if the stock market party is about to end badly?
The key principle here is mean reversion. The gap always closes. Either the LEI recovers and Main Street catches up, or the stock market corrects downward to meet reality.
So what's the tell?
If you want proof that the real economy is healing, you have to watch the ISM Manufacturing Index. It needs to rebound, and not just a little, but decisively back above 50. If we see factories getting more orders for a sustained period, that's your confirmation. It means the credit crunch is easing and Main Street is recovering. If that doesn't happen, well, then the current stock rally is built on hope and liquidity, and it runs the risk of being a house of cards.
That is a critical framework. Okay, so let's use that as a transition. From the persistence of high prices we just talked about to the new political strategy to deal with it. It seems like the pain at the grocery store is driving a new, very aggressive political strategy from the White House.
It certainly is. And this development is injecting a huge amount of new political risk into what's supposed to be a safe defensive sector.
Right. On December 5th, the White House activated a special task force, DOJ and the FTC, to go after unfair practices in the food supply chain. So why is President Trump suddenly targeting the price of groceries with this kind of aggressive task force?
It's a classic political maneuver. It's about shifting the blame before it even arrives.
Okay.
The administration knows inflation is sticky. They also know that they're about to roll out massive universal tariffs and new China tariffs starting in January 2026. Those tariffs are going to raise import prices on a lot of things.
Including food.
Including food and fertilizer. So, to get ahead of the criticism about inflation that's sure to come, President Trump is framing the current high prices as the fault of colluding foreign enterprises. He needs a scapegoat, and he seems to have found one.
And the sources are very specific about who those targets are. These aren't small companies.
Not at all. The scrutiny is very focused. We're talking about the massive Brazilian meat-packing giant JBS and Smithfield Foods, which is, and this is key, owned by China's WH Group. The administration is essentially saying they think these companies use their huge market share to artificially inflate prices for American families.
And they're not just calling it price fixing, they're escalating it, framing it as a national security issue.
Precisely. They're using a food security frame. The argument is that foreign control over American food is a strategic national security threat. And that's the part investors really need to pay attention to, because calling it a national security issue, well, that could open the door to much more aggressive actions later, things like forced asset sales, if the political will is there.
So as an investor, the old rule book says food stocks are a safe bet during inflation because they can just raise their prices. What happens to that idea when the government steps in like this?
That old rule book is now basically broken. When the government launches price collusion investigations, it forces these companies into what we call a margin squeeze.
A margin squeeze. What does that mean in simple terms?
It means if they dare to raise prices to protect their profits from inflation, they immediately paint a bigger target on their back for huge government fines, lawsuits, maybe even price caps. They're forced to just eat the higher costs instead of passing them on, and that absolutely crushes their profit margins.
So the strategic play here is to get away from these big foreign-owned food giants.
Absolutely. I mean, any investment in multinational food corporations, your Nestle's, your Unilevers, and especially these foreign-owned U.S. firms, should probably be avoided right now. The risk of fines or price caps is just going to be a constant weight on their stock price.
Okay, so if foreign competition is being squeezed, who stands to win in this new food security environment?
The focus naturally shifts to U.S. native agricultural firms, the ones that are seen as, domestically critical. So you're looking at U.S. grain companies like ADM and Bunge, or U.S. fertilizer companies like CF Industries. As their foreign competition gets targeted, these domestic players could actually get government support. They benefit from less competition, they gain market share. It turns a political risk into a domestic opportunity.
And if we pull back to the bigger picture of inflation, what does it tell us that the administration is even resorting to these kinds of tactics?
It's a huge confirmation signal. It's an admission that inflation is persistent and structural, not something that's just going to fade away on its own. The fact that they're using heavy-handed tactics like price investigations, it tells you that free market forces aren't bringing prices down fast enough for political comfort.
So for investors,
For investors, it just reinforces the need for real inflation hedges in your portfolio. Things like physical gold or Treasury inflation-protected securities, what we call TIPS.
let's move to our third and final deep dive, and let's go across the Atlantic to Europe. We're seeing this massive fundamental shift happening in defense and energy independence. This isn't just a temporary reaction, is it? This feels structural.
It is a total transformation.
Yeah.
And it's driven by two very clear goals. One, executing a final separation agreement from Russian energy, and two, strategically cutting their dependence on U.S. defense guarantees. And both of these shifts are creating investment flows that are, they're guaranteed to last for decades.
Okay, start with energy. The update from December 8th shows they're moving even faster on this divorce from Russia than we thought.
That's the key. They just finalized their 15th sanctions package, and it explicitly bans new contracts and any transshipment of Russian LNG starting January 1st, 2026. This is them fast-tracking the timeline, which shows real political will and, more importantly, confidence in their backup plan.
And what is that backup plan? They wouldn't risk people freezing in the winter.
No, they've executed a really flawless substitution strategy. They've already locked in plenty of replacement LNG from the U.S., Qatar, Norway. And critically, their storage facilities across Europe were over 95% full heading into winter. They've done the logistical work.
And long term.
Long term, the plan is nuclear. The nuclear alliance, led by France, is gaining a lot of political power. And they've already passed EU-wide rule changes to make it easier to build small modular reactors, or SMRs. That's for long-term security.
That energy shift is huge. Now, let's talk defense, because the main driver for this rapid rearmament in Europe, it seems to be coming directly from President Trump's recent ultimatum to NATO.
It is absolutely forcing Europe's hand. The ultimatum is demanding that NATO members immediately raise defense spending to 3% of their GDP. That's up from the old 2% goal. And the threat is, if you don't, you could see U.S. troop reductions. It's forcing European leaders to seriously prepare for a non-U.S. NATO, if it comes to that.
And going from 2% to 3% of GDP, that is a massive amount of money. And we're already seeing some pretty serious remilitarization moves, which tells me they're taking this seriously.
Oh, absolutely. The commitment is there. Germany, for instance, has brought back selective conscription. They're surveying all their 18-year-olds and calling some up for service. That's a huge step we haven't seen in decades. And at the EU level, they're integrating their defense industry. They're even offering tax breaks for countries that buy weapons jointly, specifically to reduce their reliance on U.S. systems and build up their own European defense giants.
So this is a signal that defense spending is basically becoming mandated, it's structural, and it's recession-proof. Where's the money flowing for an investor given this shift?
This is probably the top structural growth theme for the next 10 years. European defense stocks are just poised for massive guaranteed order growth. Companies like Germany's Rheinmetall, France's Thales, Sweden's Saab, their order books are going to be full for years, regardless of what the economy does.
And what about on the energy side of this new Europe?
We're seeing a sustained energy infrastructure boom. Companies that specialize in LNG terminals and transport tech, like GTT, they benefit directly as all these new supply routes are built. And the big push for nuclear power is long-term boost for the whole supply chain, from uranium miners like Cameco all the way to the European companies that will build and operate these new reactors.
But there has to be a risk to watch out for here.
There is, a critical one. All of this defense spending dramatically increases government deficits across Europe. You combine that with the ongoing geopolitical tension, and it creates a persistent weakness for the euro against the dollar.
Yeah.
So if you're an investor buying these promising European stocks, you have to be mindful of that currency risk and consider hedging your returns to protect your gains in dollar terms.
So to quickly recap the three powerful insights we've gone through today. First, we navigated that severe economic silo, the huge gap between Wall Street's excitement and the struggling Main Street economy. Then we discuss the politicization of your grocery bill, which kind of breaks the old investment rules and signals that inflation is here to stay. And finally, we detailed Europe's accelerated structural pivot toward defense and energy and pointed out who benefits.
Yeah, and the overarching lesson here is that a lot of the new risk is concentrated in these non-financial sectors. So, given the deep cracks we see in the leading economic index and the fact that stock markets can't run on hope forever without the real economy, here's a thought to leave you with. What critical piece of real economy data, something outside of tech or AI, are you tracking right now to manage your own risk? Is it commodity prices? Is it durable goods orders? That's what you should be mulling over today.
Food for thought indeed. We appreciate you tuning in. Don't forget to subscribe and hit that like button.